C.A. Chandrasekhar Shetty, the President of KSCAA, Kumar Jagijini, Chandan Kumar Hegde, the Secretary, and Sujata, who's a good friend, Treasurer, Geetha Adiyam, Regional Council member, whom I've sort of interacted with in my previous tenure as well, and Raghavendra Puranik, who's a good friend. So, and ladies and gentlemen, here's a very, very hearty good afternoon to all of you. As always, I'm very delighted, privileged, and humbled to address what I think is the cream de la cream of chartered accountants in the country, and most certainly in the South. I'm here to speak about CARO. Sometimes it's a very nice feeling because you often think that when you're out of the council, maybe the sell-by date is gone. It's very nice to know that it's not, and you still get invited. But in all this, I must admit that in all these forums that I try and speak, or the content that I circulate, I've been the biggest gainer because I've been able to learn a lot. So continuing the same series, I'd like to speak about CARO 2020 today. So I have about 40-45 minutes to do this session on CARO 2020. Given the time constraint, we may not be able to go into detail on how you would perform an audit of every clause. But I thought it will be extremely relevant for us to appreciate why a certain clause evolved and what are the changes between CARO 2020 and 2016. And my entire presentation is structured in that mode. So it speaks about why a new CARO at all. CARO 2020, what's in, what's out. There's only one clause that's out. I really don't want to take too much time. It relates to managerial remuneration. That's the only clause that's been removed. The remaining have been modified and new clauses have been introduced. And then we quickly go through clause by clause. We spend very little time on the clauses that have not changed and a little more time on what's changed. If you're wondering why I have this Kali picture here, every time I think of the current government, I think of Goddess Kali. And you must all know the mythology on why the Kali has a red-colored tongue. So she's been summoned by Goddess Durga to vanquish a demon called Raktha Bija, which means blood seed. Apparently, this demon has come with a boon, as usual, from Lord Brahma this time, saying that every time somebody attempts to kill him and there's a drop of blood that falls on the ground, a new demon will appear. So apparently, Durga is just exasperated fighting the war, and she calls in Kali, who keeps licking the entire universe to clean him off, clean the blood and eat up the new demons. I find that this new government is in one such predicament. They try to close something, and just when they thought DHFL was over, you have Yes Bank coming in yesterday. You had ILFS coming in before that. You have a stream of corporate failures that's been besieging them. They tried to close 3.5 lakh companies and call them as struck-off companies without realizing that these 3.5 lakh companies were actually used to layer and root funds, which has all hit them in a big way. So to me, this CARO seems a very exasperated effort to rein in corporate misgovernance. Well, we often like to blame ourselves. A lot of people say, oh, this is audit failure. I can emphatically tell you that this CARO is not a sign of audit failure. It's a sign of corporate failure. Every time there is a corporate misbehavior, the government is reactive. It comes up with a new legislation to rein in corporate misgovernance, and this CARO is no exception. And that's precisely what I see. And if as the pundits believe there was an audit failure, why would they actually give such a large role to an auditor again? So, and hence I think this is, in some sense, I tend to look at this very positively. I think it's a reaffirmation of trust in the audit fraternity. The advent of CARO 2020. So why did CARO 2020 happen at all? Corporate governance failures. You open the newspaper, and starting from the VODA AGR news, right down to DHFL, to ILFS, almost every day we've been seeing an issue, bank liquidity crisis. So I think there have been very large corporate governance failures, and and today, unfortunately, for the availability of social media, news travels very fast. Lower than expected, I've been very charitable in this comment, lower than expected performance of rating agencies who've utterly failed in delivering good ratings. complex regulatory and financial reporting framework. We've embraced IFRS, which comes with its own challenges. Bankers and financial institutions completely unaware or unwilling to understand or unable to understand. I'll come to this very shortly. One of the things that I think is a significant issue in the little bit of the work that I've been doing is a banker is not able to understand what is a financial statement. He's not able to understand that a financial statement is an auditor's report plus a balance sheet plus a P&L plus a cash flow plus an ICOFR plus a CARO report plus notes and disclosures. Very often lenders give them just 2 pages of the balance sheet. I think by bringing the most significant elements into CARO, maybe we'll be able to divert the banker's attention to what's most relevant. Well, there's really no statement of objects or any explanatory note I've seen, unless I'm mistaken on this CARO, but these are what I believe could be the reasons for the emergence of this new CARO. No formal track to report critical deviations. We were always, the audit report was so boilerplate. There was hardly any space. In fact, we do have guidance notes such as CLAR, which is the compliance with applicable laws and regulations, but I seldom see CLAR deviations getting reported in audit reports, and it's been a bit of a challenge. Financial. So there are 3 reasons why enterprises fail. One is financial failure. So your client had a profit before tax, interest, but after interest there was no profit. That's a financial failure. Very excessively leveraged. Second is a business failure. Started a hotel, the hotel just didn't take off. The third most critical reason is promoter malfeasance. From the way I limitedly see it, I think this CARO will go a long way in controlling promoter malfeasance. Almost every change that I see seems to sort of point to the auditor's capability and empowerment to detect promoter malfeasance. Shell companies in gaming the systems. Whenever we had a new law that came in, it got gamed. And the IBC itself, the latest to come in, is no exception. There's been significant gaming of the system, something that even the FM spoke about in her budget speech this year. So in my opinion, it's an effort and an exasperation, and I think if we all deliver to the extent that we are expected to deliver, I think this is going to be a good effort. Having said that, I think the only thing we should be worried about today in respect of this CARO is whether the kind of effort will have a fee commensuration. So it's up to us, each one of us in this room, to go back to our clients and to impress upon the system that better quality work will warrant better quality fees. And it's also very important that you don't actually poach into somebody else's work by undercutting. And this is the time when I think as a fraternity we need to stick together and we need to work for better recoveries. Applicability. There is no change in the applicability of CARO 2020 vis-a-vis CARO 2016. Banking companies, insurance companies, Section 8 companies, OPCs, small companies, and certain categories of private limited companies continue to be exempted. I don't want to take too much time, but the thresholds are paid up share capital and reserves not more than. For the private limited companies, these are the thresholds: 1 crore capital, 1 crore borrowing, total revenue 10 crore, and all these conditions have to be satisfied for CARO not to apply. Now, interestingly, you will find that this is slightly a completely different ball game now. For example, for a company where CARO has come in, you have to report on the internal audit system. Whereas internal audit itself is compulsory under Section 138 only for very large value of companies whose paid up capital turnover, outstanding loans, outstanding deposits run to hundreds of crores. So that's a little dichotomy there, but you'll have to appreciate and align this. And what's the date from which it's going to be applicable? It's applicable for financial years commencing on or after 1st April 2019. Interestingly, it's a mid-year introduction. So you'll have to start complying for your current year financial statements that you're going to sign. So a very good idea will be to break this CARO into 2 parts. One part which you should test on 18-19 financials itself, and certain parts like your inventory, fixed assets verification, etc., that you have to do right now in March before the year gets over. And as we speak, I'll also tell you what are the safeguards for March to be done now. And one very interesting development is that it says, provided this order shall not apply to the CFS CARO, the consolidated financial statements, except clause 21. So the auditor of the CFS was not required, but it says if there are any adverse remarks in the standalone, those have to be considered by the auditor. So in my opinion, CARO 2020 completely redefines the narrative, and maybe once we try and understand why the next set of slides are done, it will help you to just appreciate CARO in perspective. It's not yet another checklist audit with this CARO. I think it's gone. So the current CARO has 21 clauses, out of which 7 old clauses have been retained as such, 7 absolutely brand new clauses, of which 2 are from CARO 2003. And then there are 7 old clauses which have got modified. This is too much of statistical data, but then the subclauses have enormously increased under these clauses. So, if you read this CARO 4-5 times, from whatever I have read, these appear to be the prominent themes. So as an auditor, if you look beyond just the transaction and don't get very transactional, I think this is what the government is trying to get at, which is controls over related and connected entities, very fundamental, basic record keeping of assets, and internal controls, internal audits, frauds, whistleblowers, loans availed and loans dispersed, not just solvency, but short-term solvency and liquidity has also come into CARO now. These are all extremely challenging to do, and the way I see it coming is, once we do this, somebody else may do another check, and just like RBI, there will be one divergence reporting for some of these issues we don't know. But this does seem an attempt for somebody to actually put the auditor as the fulcrum or the cornerstone of this whole process. I think we've become the axles pretty much of this entire corporate environment in the country today. I would look at this very, very positively. I think it's an opportunity for this profession to scale up. Coming as it does with restricted services, I think this market will actually open out. Unregulated financial transactions for the first time. If your client is running a collective investment scheme which is not authorized, he's doing his own shit business, you'll have to report it into CARO. So these, according to me, appear to be the predominant themes which the CARO seems to focus and emphasize on. And I think, yes, it seems like a very desperate bid to actually bring in as much as they can. So much so when I was talking to somebody outside, we were joking, we said for this they could have just given us a simple checklist. A 200-page checklist and said you please tick off everything, might have just been simpler. But then there are established norms and you can only tweak things a little bit, and the CARO is one such tweak. Now we move on to the clause by clause analysis. The first thing we'll start with is those clauses which have not changed at all. That's very easy because we've all been doing CARO 16. So we'll just quickly talk or touch on the clauses which have not undergone a change. There is no change in the 185-186 reporting clause, whether the provisions of the Act in relation to loans to directors, which is a significantly diluted provision now, whether there is any non-compliance, no change. 73-76, there's fundamentally no change, but important inclusion is deemed deposits. Previously, we were required to report only violations of deposits, but today if your client has taken a trade advance and not refunded it within 365 days, then it attracts the provision of 73-76 and you will have to report under CARO. When you're a child, you're playing this game called Monopoly, or trade. There will be one particular card which you will get and it will say, go to jail, go directly to jail, do not collect, do not cross go, and do not collect 200. I mean, my generation, this game was very popular. So today with this CARO coming in, I see it exactly like that. They tell you, do this, tell me this, tell me this, and tell me this. And they seem to have embanked the whole thing. And I'll explain to you why. And I also feel today, there was a question that said, is the internal audit system commensurate? All of us used to write yes. Today the government has become very smart. They've put in another clause saying, please have you reviewed the reports? So you can't say, no, the system was commensurate, but I never got any report. I think it's a significant change. So CARO, and this obviously means that your CARO has to get aligned to your return of deposit certification as well. Costing records, no change. Whether maintenance of cost records and whether your client is one such entity to which it applies, has it been done? There's no change. Statutory dues, both disputed dues and undisputed dues, along with the definition of what is not to be treated as a dispute is given. There is no change between CARO 16 and CARO 20. IPO clause, no change. Another very interesting thing is, ideally this IPO clause could have just featured in the secretarial audit report. But again, I find that a lot of things are getting, the LODR sits there, the IPO sits here. Whether some of this could have been better, channelized, one doesn't know, but it was always there. It's only where your client has raised money by way of a IPO, FPO, including debt listings. Related party transactions, 177 and 188, no change. But later there is a significant change in treatment of loans, investments, security, advances and guarantees given by company. Only on this particular line and clause there is no change, but there's quite a bit of change which comes later, which I'll walk you through. But this clause on 188 RPTs, there is no change. Non-cash transactions with directors to be reported, no change. And whether the provisions of 192 have been complied with, they're the same. Now we come to the more critical part, which is CARO 2020, what's modified and what's new. And maybe for the next half an hour, I'll run you through why I think some of this is going to be very difficult to handle also. Admittedly, you would have to sort of bear with me because the time is limited. I'll try and cover it as much as I can, but I'll leave the presentation behind. Fixed assets, paragraph had 3 subclauses, now it's gone up to 5. There's a separate reference to intangibles. Previously they said fixed assets of the company, whether records are there. Now they say, can you identify your intangibles also? The second most important thing is where assets have been revalued, they ask 2 important questions to be answered. If the revaluation is more than 10% of the carrying cost, disclose it separately. Second most important question, has the revaluation been carried out by a registered valuer under the Act? Which means an IBBI appointed RVO appointed registered valuer has to be there. Again, I'm sure there must have been enormous instances of misuse of this provision, which is why they've come in and defined it at 10%. Incidentally, in the earlier CAROs, if they had come up with this clause, they would have said something like all material revalued amounts need to be disclosed. Today the government is getting very specific, it says 10%. Similarly, if any proceedings have been initiated or pending against the company under the Benami Transactions Act 1988, it has to be disclosed. Again, with this government, one is able to appreciate a one-place enshrinement. They're just trying to pull in information from all sources, but I don't know whether they're doing it coherently. Would this have been better in my tax audit? I don't know. Again, I'm not able to appreciate why a country should have so many thresholds. You have separate thresholds for tax audit, you have separate thresholds for presumptive taxation, you have separate thresholds for independent directors, you have separate thresholds for vigil mechanism, audit committee, for internal audit, and even there the thresholds are differing here. I think unless the government streamlines the whole thing, they're going to find it very difficult to handle, and the earlier this threshold rationalization happens, the better it is for the government and the country. Because otherwise they're just going to be all over the place and it's like flies flying everywhere. Inventories is a clause that's got modified. This is para 3.2. 3 and 4 are the parts of the order actually. 3 is the entire list of compliances. It's got 21 clauses. Para 3 had 1 subclause, now there are 2. Very interestingly, the previous CARO did not talk about discrepancies at a class level. Today they say, has the management carried out, is there a proper procedure for carrying out inventory verification? And inventory discrepancies in excess of 10% in each category has to be reported. So if I've done raw material and it is 10%, I have to report. Stores and spares, although it's a small amount, it's 10%, I still have to report. So this is a very important point that's come in, which means you need to play a larger role in understanding physical verification of inventories by your client. It has to start with a stock taking instruction by the client. There are processes to be followed before, during, after the count. The government is also telling us, please tell me whether they have been accounted. The discrepancies have been accounted in the books of account, which means your excess shortages have been verified, valued, and accounted in your books. And the second part of the inventory related clause is even more lethal. It says if your client has a working capital sanctioned limit, it's sanctioned, it's not utilized or drawn down, of more than 5 crores, then you as the auditor are expected to review the submissions to the bank, which is the stock audit reports or statements, stock statements given to the bank, as well as the returns given to the bank, any returns by whatever name furnished to the bank. And you're supposed to say that the value of working capital security, which is largely your stock and book debts, are tallied to the accounts. Which means today I'm going as a statutory auditor. I have to ask my client, please give me all your stock statements. I have to tally the stock statement either to Tally or to SAP or whatever is the accounting system. Now what happens if my client does not maintain books and records? What happens if there is a difference? What happens if on September 30th they have correctly shown some number and on October 3rd they have passed a huge reversal journal entry? You know, we have these reversal JVs, right? You pass an entry on 29th, update something, and then on 3rd you write it down, back passing a reverse JV. Things like this you have to think through. Now I also don't know now whether banks will come back and say, look, we don't need a stock auditor. Now let the statutory auditor only give the stock certificate. Could well happen. Why? But all this, one more thing I've been noticing in CARO is that it's going to facilitate or necessitate a larger interaction between internal auditors, between statutory auditors, with the management, with the bank. For example, as an auditor today, if my client is refusing to give me my stock statement, along with your bank confirmation, you can today ask for all stock statements furnished to the bank. In that sense, I think it's a far more empowering situation for an auditor. Investment loans, advances, guarantee security. I think this is pretty much the biggest part of CARO which has undergone a change. Now this speaks about the loans, advances in the nature of loans, investments made by your client, guarantees, security given by your client to somebody else. Previously, everything in this clause was restricted to the parties in section 189, which is the related parties. Today, from my limited reading, it appears that you have to do these checks for all loans, advances in the nature of loans of your client, whether they are related or unrelated. I think there's a little story to this. Again, this is a personal experience. I've seen many balance sheets now where I have borrowed something, created no asset in my company, and diverted all the money to somebody else. Now, if I am not so smart, I will divert it directly to a group company or a related entity. But if I am a little smart and I know that it attracts the provisions of 185 or whatever, then I route it through some shell entities. I layer the transaction. The government says, and then the monies just don't come back. In fact, you just pull any random, slightly old company which is forming part of a larger group, you'll find a huge amount, 50 crores of liabilities and 50 crores of assets. And the second most important feature is, I take a 200 crore from a bank, right? I tell the bank I'm going to use it for X purpose. I don't use it for X purpose. Out of this 200 crores, I pass it down to 4 connected entities, 50 crores each. Now these 50 crores each show it as if they have brought in equity, the 4 entities, and they go and take a further bank loan of 50 crores each. And then from that 50 crores, again a 25 crore is gone out. So the whole banking system was getting gamed. And while we have this concept of related entities, we are yet to appreciate this concept of connected entities. There is just this one promoter in this white dhoti and white shoes sitting on the top of a building with whom there is no paper connection, and yet he controls all these entities. This is how the banking system was getting gamed, and nothing, no value getting created. Lots of these companies called infra companies, energy companies. I think the government has tried to effectively control all that by now asking for disclose, first of all, tell me how much is the amount. How much is the amount to subsidiaries, JVs and associates? How much is the amount to others? Second, auditor to state whether it is prejudicial or not. Obvious, I can't borrow at 18 and give it to my group company, interest free or at 12. Third, regularity of repayment, please report. 4, reporting of overdues, it catches it immediately. And the fifth one I thought was very intelligently thought out. It also requires the auditor to report on evergreening. So as per my original loan agreement, he is supposed to repay it this year. I just give him a general term extension to my group company and say, okay, you repay after 2 years. That's effectively just postponing the problem. So they speak about reporting of renewals and fresh loans granted to settle old loans. And I think in some sense, maybe these are all the stories and relics of ILFS which must have happened. Lots of money getting moved across entities that these controls have been built in. But it certainly seems to be a very, very technically, wanting to catch issues kind of document this time. Because I don't think any clause is vague. And the little bit of vague clauses which were there have also been corrected and refined now. So the impact will be a complete and a detailed audit of all loans and advances in the nature of loans, clear understanding of all payouts, you need to understand each outward fund movement of your client, will help to unravel complex related party transactions, layering, round-tripping of funds. Banks will be more aware of the extent of deployment of their funds for core purposes rather than for advances to group companies. In fact, in one case when we asked, why have you moved this fund? He says, please look at my loan agreement. It only says it is to be used for business purpose. So I've sent it to my subsidiary abroad. And that subsidiary abroad was in the process of getting wound up. And the impunity with which certain borrowers handle these kind of funds, I think, deserved this kind of a CARO. Only thing is, we must implement it in the proper spirit. But today, this CARO is also a license for us to ask questions. Questions that we were slightly shy to ask, because there was always this thin line of, is this propriety or is this audit? In fact, times where a client asks you, why are you behaving like a forensic auditor? Now tell him, look, I'm not behaving like anything, this is just the CARO. Another good idea will be to float this CARO document to your client and say, you please ensure that you're complying with all this. And if you have a non-compliance, please address it now. Reporting of undisclosed income. So previously when tax assessments, undisclosed incomes, transactions escaping assessment were offered to the income tax, there was no disclosure back here other than as prior period income, prior period expenses, if at all. I don't know how effectively the compliance was, but now they've said whether any transactions not recorded in the books of accounts have been surrendered or disclosed as income during the year in the tax assessments. If so, whether the previously unrecorded income has been properly recorded in the books of accounts, which means your tax books and your financial books will have to align all the time. And of course, for this, if there's an impact elsewhere, you may have to consider it. Another interesting thing that this CARO brings is, how is it going to impact my main auditor's report? And how is it going to, more importantly, impact my CAM, my key audit matters? Because in a lot of things in CARO, you're actually, there is significant exposure to the CAM related standards. So I think this is something that we might have to think through. It's again very early to be doing this also, because I think the institute will come up with a very comprehensive guidance on this, and a lot of subjectivity is involved. So I think you need to audit with the guidance note progressively. See, this also gives a higher visibility to a banker or any stakeholder if there has been a tax fraud or a search or a seizure that's been committed. Because today when you're giving a note in CARO, you're not going to say just the amount. You're going to give the background and give an explanatory note on what the transaction was. Default to lenders stands modified. Previously, they said where a company has defaulted in payment of loans or other borrowings or in the payment of interest thereon to financial institutions, banks, government or debenture holder. Now it says to any lender. So it's any person. But in the nature of a lender, I don't know where lender is not defined. Whether a normal creditor will become a lender, may not. I think it's used in a financial sense here. We'll have to wait and watch, because otherwise even your operational creditor dues will have to start. However, if your operational creditor is charging you interest, then he also becomes a lender to that extent. But all this lacks clarity. We'll have to wait and watch. But I don't know how many of you know, the IBBI has set up something called as an information utility. The one that exists is the one in Bangalore. It's called NESL. And as per the IBBI guidelines, every financial creditor in this country has to pump in debt information of their clients into this information utility. The only sad part is, every borrower is not mandatorily required to confirm it. But this is something you must insist with your clients. Because for a whole component of the balance sheet, which is your secured and unsecured loans and interest thereon, you need to perform no other audit procedure, because you've got a government-enabled portal where the number is flowing. What more would you need? Strangely, I don't find that having been introduced into CARO. It would have been a very, very strong fortification. So for example, if the lender says the due is 83 crores and your client says it's 65 crores, you must ask them to reconcile. But it gives you a very strong visibility on the loan, the security, all information is updated there. So auditors can utilize the information in NESL, established as an IU under the IBBI regulations. Willful defaulter is a new clause. Whether the company is a declared willful defaulter by any bank, financial institution or other lender. In fact, when I was thinking of this, I thought of another very interesting thing that can possibly be recommended. Today, when you look at your audit report, it's only in that page of the auditor's report where it says qualified. Why can't we bring a system, if we genuinely want to do all this, to have a chapa on every page, even including the financial statement says qualified, qualified, qualified. And ideally today as an auditor, when you're signing, you only sign as per my report of event date. Why should it not say as per my qualified report, as per my disclaimed report of event date? I think today if we want to go, we must go the whole hog. And I think we'll get there shortly, because another thing is bankers don't understand qualifications. Bankers don't understand going concern qualifications. In a lot of cases, I've again found this challenge. So the use is ultimately to the stakeholder, and if the stakeholder doesn't understand, I think we need to come up with changes too. So specific reference in CARO to identify willful defaulters. Application of term loans, it's a new clause. Whether term loans were applied for the purpose for which the loans were obtained. If not, the amount so diverted in the purpose for which it is to be used. So they want, with this and the working capital we spoke about earlier, this means and includes that the auditor needs to completely have a handle on every fund received by this company. Your term loans plus your CC plus other lenders also they spoke about, right? Any other lender. So I need to know my client got so much money. Then they say, okay, now you know your client has so much money. Now tell me whether your client has gone and given these as loans, investments, securities, guarantees to other people. So the entire fund trail is completely mapped because of this CARO. And it's also important for you to, sort of rise above that balance sheet and appreciate this fund movement. In a lot of cases, you will find that there will be a 200 crore loan, but no asset gets created. It's a problem. Or there is no commensurate turnover, assuming it's a working capital loan. And I'm not saying this about a 200 crore loan. I'm saying this even about a small MSME or an SME who's got only 5-6 crores. Another very interesting thing that's happening, because of this IBC process of late is that many borrowers are throwing their hands up and saying, look, this inventory value which is reported is excess reported and the banks are aware of it. This is a good control now to say check with reference to books to say whether the inventory values have been stated properly. The second clause on term loans is also, the other clause is whether funds raised for short-term purposes have been used for long-term purposes. If yes, the nature and the amount to be indicated. So utilization of short-term funds for long-term purposes, which means your working capital cycle gets mismanaged. Your money doesn't come back quickly enough. Related entities, it's a new clause. Whether the company has taken any funds. So till now we spoke about company giving out its funds. It's taken funds from any entity or person on account of or to meet the obligations of its subsidiaries, associates and joint ventures. Essentially, just getting the money to be a routing company to give it to somebody else. In which case, the lenders of this entity are impaired. So they want us to check this. Pledge is an old thing, it was still there. Whether the company has raised, no, I think this is also a new clause. Where the company has raised loans during the year on the pledge of the securities held in its subsidiaries. So I use my subsidiaries' shares to raise loans for myself. Again, the subsidiary gets impaired. So diversion of funds being checked closely and need to report, because this would represent a diversion from the subsidiary. Preferential allotment, they have included section 62. We normally don't come across this. I'm going to move ahead. Fraud reporting, very interesting. Previously, there was whether any fraud by the company or any fraud on the company has been noticed or reported. Now they also ask you one more question, whether any report under subsection 12 of 143 has been filed with the auditors. So it's two questions that have to be answered. It also forces, if at all you've noticed a fraud, then you have to actually say, yes, I've reported, or no, I have not reported, which means it's also forcing the auditor to report. And one advantage is, which we'll come across perhaps the next clause. Previously, you asked the management any whistleblower complaints, they say, oh, nothing from the whistleblower. But now it's not like that. Because it's a specific CARO line, you will be getting a management representation letter on this. To say, yes, there are whistleblower, no, there are no whistleblower complaints. And what's the advantage? Once the whistleblower complaint is there in your hand, you as an auditor, your own antenna also goes up. If somebody talks of a procurement fraud, then your own need to deep dive becomes increased, because of which the previous clause that we spoke about, your 143.12 responsibilities get discharged much, much better. Nidhi companies, slightly modified. The last para alone has been added, whether there has been any default in the payment of interest on deposits or repayment thereof. Surprisingly, a very simple and a basic clause was not there in the earlier CARO, brought in now. Internal audit system, new, we spoke about it. Currently, only those companies which are covered under 138 are required to have a mandatory internal audit, whether paid up share capital, turnover, outstanding loans, outstanding deposits, the 200 crore threshold range. But now, every company for which CARO applies, including private companies with a very small threshold, beyond a small threshold, you have to comment on not only whether the company has an internal audit system commensurate, you also have to say whether the reports of internal auditors for the period under audit were considered by the statutory auditor. Which means all you need to go back is wherever you're the statutory auditor, make sure a small internal audit is actually in place. And I would think it's very important if your client has any kind of bank borrowings. Please ensure compliance with this. It's a very large role for internal audit. The new CARO makes it mandatory for companies under CARO. Now, not just the existence of a system, so you don't write something vague. Larger interactions between internal and statutory auditors, and an eyewash internal audit is no longer possible. Another very important thing is we're sometimes very sweet. When you have another firm which is doing the internal audit, you don't feel like commenting on it. But that firm would have wantedly been, in fact, this happened in the case of a very large listed company, where a certain internal audit firm was appointed only to audit the liabilities. It was an NBFC. They were not even given scope for assets. And the whole company collapsed. 1,000 crores gone. Today, as a statutory auditor, somebody did not comment, but then they should have said that the scope is not adequate. A lot of times you don't understand what the management has agreed with the internal auditor, but please open it out. And in cases where you find that the internal audit is not commensurate, please state so. Because not only are you saving yourself, you are saving the company and you are saving that internal auditor also. RBI registrations. This was a clause whether the company is required to be registered under section 45IA. The second is an interesting inclusion. What generally happens in India is a lot of people run these unregulated financial schemes. Collective investment schemes. If your client is doing something like that, then it attracts non-banking financial or housing finance activities without a valid certificate of registration. In fact, there are some SEBI guidelines on this collective investment schemes which you may want to go through. So if you find that your client is collecting money from small people from somewhere, in fact, I've seen it with one company which I've worked on. There would be an intermediary finance company which will organize the money, but the money will come from 300 names which will be attached as a list. This is actually acceptance of deposits from the public. It's a completely unregulated operation that you're doing. So this is important. Core investment company new, again must have been the result of multiple failures. A core investment company is necessarily an NBFC whose 90% of their net assets represent investments in their own subsidiaries and group companies. So they also want you to say whether your own client is a CIC, a core investment company. So they want you to say whether the company is a core investment company as defined in the regulations made by the Reserve Bank of India. If so, whether it continues to fulfill the criteria of a CIC, and in case the company is an exempted or unregistered CIC, whether it continues to fulfill such criteria. And where the group has more than one CIC, indicate the number of CICs. A lot of times, even with the previous clause, we don't generally tend to associate our clients who are in manufacturing or in services to do financial sector activities. But in a lot of these cases, they end up doing it either in the form of receiving deposits or in the form of setting up these kind of behaving like a CIC. Please take care. Cash loss reporting, new. Where the company has incurred cash losses in the financial year and in the immediately preceding financial year, state the amount of cash losses. This was, I think, there in CARO 2003 and it was brought back now. Computation of, 2003 had this clause. So, as your client today has to give you a working on how he arrives from his book loss or book profit to a cash loss, which is adjustment for non-cash items such as depreciation, amortization, deferred tax expenses, etc. Now, that is one part which is easy to accomplish. But the parts which are difficult to accomplish are, what if I have come up with an audit qualification saying this particular depreciation is short provided. Now, you have to adjust that also in arriving at the cash loss because you are reporting under CARO. Now, let's think of a third circumstance. I have qualified, but I am unable to quantify. In which case also it has to get reflected in the CARO clause. And then, if the impact of the work is so pervasive, it might have to go into your main audit report to qualify your opinion. That is going to be actually the difficult part. How you will marry these blocks to make your, standard audit report, in compliance with the law. Effect of quantified and unquantified qualifications. Resignation of auditors. It's a good one. I think the whole country has been sort of besieged by a spate of auditor resignations. I think it's a good thing because at least somebody is putting their arm up and saying, look, we can't do this anymore. And there is also an end. See, the first few auditors who resign would be criticized. But as more and more of us sort of start throwing in the towel and say, we can't do this, I think it will also result in a corporate sector reformation. And again, the challenge is if somebody is resigning, you need to think 20 times before you accept that engagement. But what's very good is it says where there has been any resignation of a statutory auditor, if so, whether the auditor has taken into consideration the issues, objections and concerns raised by the outgoing auditor. I think an auditor's role with the coming of the Companies Act, I wouldn't blame the government at all. They've given you visible and invisible spears. If you don't want to go and use these spears, they can't help you. Look at it this way. First of all, you're appointed for 5 years. It's not 1 year. Even whether it's a company under rotation or not under rotation. The second thing is it's made removal darn difficult. Nobody can remove an auditor so easily today. The third is, okay, you could be asked to resign. But today, even if you resign, your incoming auditor has to address your concerns, which means, again, your resignation letter and your issues and concerns document is a very powerful tool. So, I think if we just need to use this, issues, objections or concerns have to be addressed. So, it's not like somebody says, you want somebody to make a 10 crore provision, he says, sorry, you can't make the provision, you resign, I'll put somebody else in that place. If you leave a note in your letter saying, look, I wanted there is a 10 crore short provision, the incoming auditor is expected to take cognizance of it. So what people, I've actually seen this happening is, they'll be assuming 2 stools. The resignation is a nice drop of an issue between the stools. And for a new auditor to come and fathom and understand some old issue will take him another 2 years, by which time he'll be ready to resign. And I think this is pretty much what must have happened in the very large entities where there were resignations in the past. Short-term solvency, absolutely new and difficult one. Now it says, on the basis of financial ratios, aging and expected dates of realization of financial assets. What does that mean? All your assets which are going to get realized, your loans and advances, your debtors, your other receivables, and payment of financial liabilities, whatever you're supposed to pay, other information accompanying the financial statements, the auditor's knowledge of the board of directors and management plans. Just look at the amount of documentation you will have to build up to address this clause. There has to be a board giving you a certificate saying, this is my plan, yes, this money will come. Once this comes, I am going to discharge this liability. Whether the auditor is of the opinion that no material uncertainty exists as on the date of the audit report, that the company is capable of meeting its liabilities as and when they fall due within a period of 1 year, that too where? From the balance sheet date. The reason why I am emphasizing on this clause is, please don't just look at the balance sheet and say, yes, no material uncertainty. For this particular clause, you must go through the sequence. Financial ratios. What are the financial ratios? I would sort of pick very easy. 1 would be your debt service coverage. 2 is your interest service coverage. 3 is, of course, your creditors. You will have your cash flow forecast saying, I have to pay this time. But this will be your major elements will be your loan repayments. Aging. How many of us check the quality of aging? Very few. In Tally, if you go pass a debit note or a credit note, and you pass a debit note again, the aging will change. I will have a more than 90-day outstanding, 5 minutes. Suppose I have a more than 90-day outstanding, even let's say in SAP, I can pass a credit note in my debtors ledger and pass a debit note again today. So my aging gets reinstated. Some of this you'll have to be very careful. Aging, expected dates of realization of assets and liabilities. So again, please await the institute guidance. A lot more will have to come into it. In the current business atmosphere, I think a lot of clients may not pass this test. And today as a country, there are 2 tests for determining solvency or insolvency. One is called as the cessation of payment test, which is the default test. And second is the balance sheet test, where there's an erosion of net worth. Now, India as a country is moving away from the balance sheet test. We're no longer going to, the CARO is repealed. So no longer are we looking at, erosion of net worth. We're looking at default. Today, if my assets are insufficient to pay my liabilities, I am not solvent. And that's your opening premise of your insolvency law in India today. The same thing has flown here. So this would also call for greater examination of defaults. Creditors aging. We see debtors aging. Do we see creditors aging? Why is my creditor not getting paid? Another thing about diversion of funds is, a lot of times my debtors aging will just keep showing, whereas my client would have told my customer to pay directly to a supplier. Because he's scared that if he pays into this company, the banker will take the money. These things are very, very commonplace, but we've yet to sort of, but looking at CARO now, it appears that you'll have to go through, just as how you review a cash credit account for your CARO, for your bank audit purposes, you will have to review your client's banking transactions. Review of bank statements and bank books will become paramount with this CARO coming in. CSR, I'm not going to focus too much. I just had one clarification that I hope the government will address, is that this particular 135.5 is not yet notified. Sorry, 135.5 or 135.6 has not yet been notified as of date. So maybe they will also defer the CARO implementation for this particular clause. You can look at it in the e-book. There was a slight deferment on this. I think it's the transfer to the special account. This is what I had mentioned, where there are any adverse qualifications by the respective auditors in the CARO of the standalone statements which are getting consolidated, then indicate the details of the companies and the paragraph numbers of the CARO report containing the qualification or adverse remarks. So as the CFS auditor, I am required to at least bring to the attention this particular adverse remark on this CARO. So it does two things. It heightens the standalone auditor's responsibility. Two, the CFS auditor has to review all standalone CARO reports. Third, what do I do if my standalone has not yet got audited? How do I handle it? So these are again the situations that will come. But I feel sometimes more is better than less. So for every paragraph, it's not wrong if you want to give a very detailed and an elaborate explanation. I would do it if I were you, because I think in the case of an auditor's report, it's our neck that's on the block. And a lot of these CARO clauses today, see, today you can take a representation letter for any other assertion, existence. You can take an assertion for valuation, but you can't take an assertion letter for genuineness. A lot of the CARO clauses focus on actual genuineness and propriety of transactions, on defining related parties, etc. So you'll definitely need to have much larger safeguards. And accordingly, your management representation letters will have to change, your audit engagement letters will have to change, the quality and the quantity of your working papers for this CARO will have to change. I would think that you'll need not less than, if you're looking at a company which has a bank exposure and which is sort of many entities in the group, it'll certainly increase or double your audit time. So please take care about it. And of course, as I had mentioned, the opening parts of my speech, whether, you'd be able to complete what I call as the fee loop. You need to increase your charge outs and your fees, because I think the quantity of work is much, much higher now. And not only is it higher, it's also riskier. So tomorrow if you're called to do one explanation, it's going to take you 4 or 5 days to write your explanation. So ends with this question again. I see this government with a very, very red tongue trying to lick and clear the whole system. Will Swachh Bharat ever happen, and can the goddess rest? I think the answer to this question lies in absolutely the people in this audience. And sometimes with the kind of feedback that you get in some of the DC cases, I wonder whether there is a crisis of independence or integrity. And very sadly, when we compromise for a client, there is no quid pro quo. It's just that the auditor says, poor thing, let's do it. I think no. Be very clear, you're not protecting anybody in this system. And secondly, as I've always said, the bottom line is to be skeptical. You trust the client, but you verify. And that's about all I wanted to say. And thank you so much for this session today, and look forward to connecting in the future as well.